Hello, everyone, and welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's best macro minds. I'm your host, Kinsey Grant, and we are here with you today to discuss the current market environment, the Fed's market influence through the rest of the year, and signals that derivatives and flows are providing for investors like you. Don't forget to like, comment, and subscribe to our YouTube at Public Invest for in-depth interviews to help keep your portfolio on track. I'm so excited to welcome our guest today. We've done this once before. I'm excited to do it again. Cem Karsan, founder of Kai Volatility. Cem, welcome to Public. How are you today?
Good. Thanks for having me.
Of course. Yeah, we were just chatting before we hit record here about how it's been one of those market Mondays. Lots to talk about, lots to uncover. I'm excited to dig into it with you. And I think one of the best places to start here is just by getting your perspective on some of the moves that we've seen in the stock market in kind of the wider lens look here. Markets experienced some pretty notable downside in September. The S&P 500 fell 4.9% for the month, which is typically the worst month for stocks. But since then, in October, since the beginning of October, the S&P 500 and the NASDAQ are both up around 2%. Talk to me about why that is. Give me your big picture perspective on how we have, had some positive sentiment seep into the market lately.
Yeah, so SEP quarterly OPEXs are options expirations are always big. All the quarterly OPEXs are. September in particular, vol has been very well supplied on the market. We've talked about this structured products, right? The structured product issuance is at records. That means banks are taking on tons of implied volatility and then forcing that on the market, particularly in the S&P 500 in the center of the kind of vol complex. That has been a pinning force in markets. That's part of why we've seen such positive performance this year, despite all the macro headwinds. That said, that stuff is particularly important and supportive into big quarterly OPEXs where most of that issuance happens. So that's what we saw, a decent amount of support going into SEP expiration. Of course, what happens after expiration itself happens, exactly what we saw, a kind of a move up and then a big drop, right? And that's those structural supportive, what we call Vana and charm flows, the decay of skew coming out of the market. And you can often see these big declines that happen immediately after them, and that's kind of what we predicted and we saw. What's driving the negative flows? That's kind of driving that against these structural positive flows. Issuance from the Treasury, no big surprise there. We're seeing a ton of liquidity coming out of the market ever since the debt ceiling passed. The Treasury has had to refill the Treasury general account. All of that Treasury issuance, $1.6 trillion of issuance, that's coming out starting from after the debt ceiling all the way out till January of this year. All of that issuance is a direct suck on liquidity out of the market, not just the bond market, the stock market as well. To put that in perspective, $1.6 trillion. The market is about $100 trillion. The U.S. and global equity market's about $100 trillion. And the daily amount that it takes incremental amount that it takes to move equity markets on a daily basis, about 50 billion. So 1.6 trillion is a ton of liquidity draw out of the system in that quick a period of time. And that's been the overhang. So, but in the absence of the supportive flows, we get a down move despite vol being well supplied until we get through those 2 weeks or so where there's not those flows, and then here come those flows again, right? And we picked out on the calendar we were very open about this in September, that October 6th, we picked that day would be when those flows come back. And sure enough, if you look at a calendar, here they come again, right? Pushing back up against that issuance. So that's why we're seeing what we're seeing. These are the flows at work and how they operate against the macro flows. But what's important to note too is it's not just these options flows, right? There are other structural flows that are even more important that are coming, and they're a big driver for what we call seasonality. And so November and December, we have significantly less trading days. Even the days that the market is open, there's much less volume and liquidity. That drives an acceleration in time, particularly on a big quarterly OPEX. Again, December, which is out there for years in advance because of leaps and whatever, ton of open interest. And the decay of those options in particular, very important into the end of the year with this accelerated time. You pair with that an up year, 17.5% or so return for the year. That's new collateral that needs to go to work January 1, which leads to what we know, the Santa Claus rally, the January effect that sit out there. All of those pressures, all of those buying pressures are sitting out there in November and December. And here we are 2 weeks away. So very constructive beginning to a period. That's why we picked October 6th on a calendar for a return to kind of a positive uptrend. And that's what we're beginning to see now. After a very short kind of September week period. So seasonality, I like to say, is not a magical construct. It is a thing that is a function of supply and demand in the market that are tied to calendar effects, both from reinvestment of capital as well as expiration cycles and other things tied to structured products.
Yeah, this idea of the structural flows and how this might impact the rest of the year is certainly really interesting. And you hit on something that I would love to dig a little bit deeper into. This idea that on October 6th, change was going to begin happening, that you made this prediction and that things have sort of panned out in that direction. I'm curious about why this feels in some ways like a bit of a departure from the norm for the way that the market tends to operate around this time of year. Talk to me a little bit about why there is a bit of fear associated with, how markets might operate, how indexes might operate around this time of year, and whether or not this might be different from the expectations that most investors had heading into October.
Yeah. So despite what you may hear, if you actually look at the numbers, October 6th, October itself is not the worst month. September is, right? September is the worst month, and October is actually the third worst month of the calendar. And it actually can be a very positive month, particularly if September itself isn't that weak. When you see a weak October, it's usually a continuation from an already weak September. So in periods where the September is not that weak, October can actually be quite strong and kick off a very seasonal last quarter of the year. And we like to pick out months because that's how we think, September, October, but these calendar effects are actually not really necessarily, a lot of them are not first of the month to second of the month, right? You have this actually pretty seasonally structurally positive period at the beginning of October due to these Vana and Charm flows for an October expiration that can be structurally positive. So the beginning of October can actually be quite positive a lot of times. And even the end of October then starts to turn as well. So again, based on how vol is well supplied, we haven't had vol break like we often do in September. It was very well supplied throughout the month. Dealers are stuck very long and laden in vol that they have to hedge, and that's kind of pinning the market. With all of that out there and a September that was very controlled in terms of its decline, not a surprise that when the flows start coming back, that we start to see a little bit more positivity.
Yeah, one of those all things considered market stories. I appreciate the insight on that one as well. And you touched on yields and the bond market a bit in the beginning of this conversation, but I would love to shift focus a little bit to talk more about this. Yields have continued to remain elevated after the 10-year Treasury yield hit a 16-year high earlier in October. I'm curious to hear from your perspective what story this is telling for investors who are potentially interested in investing in this part of the market, who might already be invested in this part of the market. Talk to me a little bit about what the reality is that you're seeing out there.
Yeah, so inflation is not one thing. Inflation has multiple pieces. For about 30, 40 years, everybody looked at inflation as one number because it really was a function of cyclical dynamics. Was the economy hot or was it cold? And that was really a function of the fact that we didn't have any secular inflationary dynamics. We had a very structurally, secularly deflationary environment really for the last 30 years. And that was a function of monetary policy, of the ability for the Fed to constantly stimulate with more and more monetary policy and drive money to capital whenever we had a cyclical downturn. That itself was deflationary, right? That spurred globalization, greater technological development. I can go on and on about all of the deflationary effects that drove. That would be great. That could go on forever, right? In theory, if there weren't people in the system. Unfortunately, there's a cost of Federal Reserve monetary policy dominance in the last 40 years of Federal Reserve dominance, and that has been driving dramatic inequality. And that inequality has taken hold, particularly it took a while. We started hearing about it about a decade ago with Occupy Wall Street and Tea Party and all these things. But demographically, the political dominance of the younger generation, who was labor in that demographics, right? Who left high school and college and started to work, and didn't have the capital and the benefits of the capital. Ultimately, as they grow to political dominance, millennials are the next demographic bubble. It's driving a different kind of policy, and this populism, which is effective of how they grew up in what they feel is an unfair kind of situation, is driving very different policy now. We went from a 0.35 Gini coefficient, so the width of the distribution of wealth has gone from 0.35 to 0.45. It's dramatically wider haves and have-nots. And so we're driving more fiscal policy, more government involvement as opposed to monetary policy. That's demand side economics. Instead of sending money to what I call Planet Palo Alto, to sending it over to corporations and that money never really entering our economy, the velocity of that money being very, very close to zero. And instead, we got all these Amazons and Ubers and Teslas back from Planet Palo Alto, which are deflationary. Now we're sending money to people. And when we send money to people, that's inflationary. And so we're in a very different type of economy with very different types of drivers, very similar to what we saw in the 70s. That demand side economics is ultimately structurally inflationary. So what does that mean to bonds? That means we're getting now secularly, structurally inflationary forces. We're getting more labor rights. We're getting more protectionism. We're getting less money going to capital, so less technological development, less globalization. All of these things ultimately are structurally inflationary. So we can try and manage them. The Fed can try and manage them with cyclical pressures to try and slow down the economy. But at the end of the day, taking money from rich to poor means, even if there's the same amount of money in the system, means you drive an inflationary, structurally inflationary environment. So that's where we are. That's why you're seeing the longer end of the curve wake up, despite what we saw with cyclically slowing deflation, because now the Fed has got is going to slow down the rate of interest rate increases. And so the cyclical effects they've been using to battle secular inflation are now slowing, which means we're likely to start seeing higher and higher inflation again here. And I think the bond market's waking up to that. It's what's flattening the yield curve, is steepening it even a little bit. And that itself is going to is kind of the next chapter in the story. We've been talking about this for several years. People were kind of still playing this cyclical game and expecting the curve. That's why the curve's been in backwardation. They've been expecting the longer end to kind of come back down. That hasn't happened. It hasn't been transitory, and it's for these structural secular reasons. So I know a long-winded explanation, but you really have to understand the drivers of what's happening underneath the hood, why 10-year yields are going at 16-year highs, and why they're likely to break out and go higher, maybe not overnight, maybe not the next 2 weeks or the next quarter, but there's a structural climb in long-term yields. And we believe that they'll actually get above 10% here in the next 3 to 4 years, maybe a little bit longer, maybe 5. But sometime in the next 5 years, we would expect significantly higher yields at the long end of the curve. Anyway, that's the reason. That's what's going on behind the scenes. Again, you really have to break it down into cyclical effects, which is what all that's mattered for the last 34 years, to now accommodate this new secular reality, which is the Fed is in a box and they're dealing with an inflationary pressure that they can't really control. And that's really a political reality that has to do with people in the system and inequality.
Yeah, and deeply interesting, context, I think that often might be lacking from the conversation around Fed policy. We talk about these certain buzzwords that we hit all the time, the soft landing and the dual mandate and all of this, that, and the other. But, it's interesting to hear that there's a lot more to these decisions than typically meets the eye, than even might meet the eye of the FOMC's, disclosures at every other meeting, right? So it's interesting to understand this a little bit more. And I'm curious, with all this in mind, you mentioned that the bond market might kind of be waking up to the realities of what's happening with policymaking in this country. I'm curious about how this impacts people. Like when I look at what is happening to me, to people who are listening to this, to kind of the everyday people who are out there, talk to me a little bit about what the rest of this year and heading into 2024 might look like with all of this in mind. What might be some of the realities that we're facing as investors, but also just as participants in an economy?
Yeah, so I think it's incredibly important for people to understand, for the most part, people have been taught, and this is incorrect, that the market represents the value or performance of the economy. That is not true. I hate to bust the bubble there. The reality is 1968 to 1982, the last period we had an inflationary period, The stock market broadly went nowhere for 14 years in nominal terms, and in real inflation adjusted terms lost 70% of its value. You would think, oh, the economy must have been really bad 68 to 82. Quite the contrary. 68 to 82, the economy, actually GDP growth was above trend. It was significantly hotter than it was in the last 20 years. Stock market in real terms has returned more than 12% per year in real terms, right? Or more than 10% per year, but 12% nominally the last 15 years with much weaker economic growth. Well, that's confusing, right? Like, why is that happening? Pretty simple when you start thinking about it, markets in supply and demand terms, no longer about whether it represents the economy or fundamentals. In supply and demand terms, if interest rates go higher, right? If we have interest rates go to 10, 15, 20% like they did in the 70s, you have an alternative to your investment, right? You don't need to go invest in the stock market. You can go put your money in 15%, annual returning treasuries. What that does is that creates massively less demand for stocks. And this is, at the end of the day, that liquidity coming out of the system that we talk about. When the Treasury needs to issue T-bills or needs to raise money and it's more expensive, at the end of the day, that is a suck on liquidity, not just from the bond market, but from the whole asset and investment space. And that's what we saw for 14 years, that money kept flowing out of the stock market. Money was getting drawn out of the system broadly. There was no demand for investment because that money was going to individuals as opposed to capital. The Federal Reserve has been sending money to capital all these years. Now it's saying, no, we're not going to send it there anymore. We can't because the Treasury is sending money to people, right? And if the Treasury is sending money to people, that is not asset inflationary, which is what we've been seeing for the last 30 years. It's goods inflationary. And that's what's driving the inflation. We're actually withdrawing liquidity from the investment world and giving it to people. And that is a very different type of economy. What that does, that pushes a demand push economy, which again tends to drive inflation. It can drive quite a good amount of GDP growth, but it's bad for margins. First of all, it can, higher cost of capital, deglobalization, less technological growth. All of those things drive worse margins. They drive, significantly worse multiples in markets because there's less demand. The risk premium goes up because volatility increases during periods like that. And all of that drives, again, money out of risk assets. So important piece here that I'm trying to get to. Again, long-winded, trying to give you a lot of information in a short period of time. But the reality is that the market is not the economy. And the economy could very well, like we've seen for the last 2 years, people have been talking about a recession for 2 years. Where's the recession? We're still at 3.5% unemployment. The recession isn't there because we're driving a demand push economy. There's more labor rights. People are making more. They have more secure jobs. We're shutting off borders and doing deglobalization, which is driving more money going to labor. But that's not great for corporations and margins necessarily and earnings. And it's definitely not good for capital chasing investment. So it can be not great for the market, but it might be good for you, Kinsey. It might be good for a lot of people, right, out in the real world. And so it's important to note that the market doesn't necessarily reflect that. So the economy should be better for your average person, actually, ironically, but that might not be good for investment.
Yeah, it's definitely an interesting way to wrap this conversation up, to understand the divergence here between stock market and economy, these two huge behemoths that we pay so much attention to as people, as investors. But with that, we are people and we're investors. So I think it's a very interesting way to wrap all of this up. Jem, thank you so much for joining us today. I really enjoyed getting all of this insight. Such a densely packed episode for people to listen to. I'm sure they learned a ton. I definitely did. So thank you for stopping by today.
Thanks for having me, Kinsey. It's a pleasure.
Thank you once again to our guest, Cem Karsan, founder of Kai Volatility, and thank you to all of you for listening. See you next time.